Hello, hi everyone. I'm Shekhar from Momentum Lab. This is the third video in the factor investing series. In the first video, we have shown all the single factors and their performances. In the second video, we have shown that when you compare or when you combine two different factors which are least correlated or negatively correlated, then the resulting strategy will yield better results. Not all combinations might yield better results. The ones which are doing inherently well, as well as have some kind of low correlation, are doing much better. So a prime example for this is momentum and quality. So out of all the combinations, we have seen that momentum and quality yielded best results. So one combination is yet to be explored, which I've missed in the previous video. Now I want to cover in this video, and I want to do a deep dive on that. Now in this video, I'll be focusing on the combination of momentum and low vol. Apart from this, we'll also discuss two more optimization techniques. You're already aware of these techniques. One is if we overlay absolute momentum on top of low volatility plus momentum multi-factor strategy, will we get better results or not? Similarly, we'll also see that if we apply dual momentum on top of low vol plus momentum combination, what are the results going to be look like? So for the combination of low vol and momentum, we have taken two indices. For low volatility, we have taken Nifty 100, low volatility 30. And for momentum, we have taken Nifty 200, momentum 30. Now the correlation of excess returns between these two factors, when I say correlation of excess returns, it is over and above Nifty 50. It is at minus 0.06, meaning they are very less correlated. Now, if you see, the combination is plotted in the yellow color, whereas momentum is in red color and low vol is in blue color. Nifty 50 is in green color. Now, the switch between momentum to low vol happened somewhere between 2016. Earlier, low vol was performing well, and post 2016, momentum is performing better. Now, across both the time periods, both of the strategies, momentum and low vol, have always performed better than Nifty 50. So that's at a high level of the performance. Let's see the distribution of the excess returns. I'll quickly show you how the excess returns are calculated so that you can appreciate this graph even better. Now we have in this sheet I've already shared. I'll again share this in the YouTube description. This is basically the raw data that we have got, and from the raw data we have done an analysis on top of it. You can see the analysis as well. So first we'll get the 3-year returns of the individual strategies, namely Nifty 100, low vol 30, as well as Nifty 200, momentum 30. We take the 3-year returns. And from these 3-year returns, we then subtract the 3-year returns of Nifty 50. Thereby, we get the excess returns of this factor over Nifty 50. Now, this excess returns is what we have plotted in this graph. Now, the excess returns are again classified based on the time period. Now, if the time period is between 2008 to 2016, then it is marked in blue color. If it is between 2016 to 2024, then the excess returns are marked in red color. Now, the dark red or crimson red that you see is an overlapping period, overlap between these two, meaning that the values which are falling are present across both the time periods. The need for plotting in two different colors between two different regimes is that most of the combinations that I've observed, they made a switch, or especially between 2015 to 2016 times. Pre-2016, some factors were doing really well, and post-2016, the factor switch happened. And that's an example we have just seen right, of low vol plus momentum. Same with low vol plus momentum. I've also shown in my previous video that the switch was observed between alpha and value, momentum and quality. So that's the reason I wanted to see if between these two regimes, as we can visually see, is if there's any difference between the excess returns. Ideally, we want a factor to work in both the regimes, irrespective of which market condition or type it is. Now, if any factor is working really well in one market regime and not doing that great, we may want to avoid that, or may want to have less exposure, because we want to have those factors which are consistent across the time period. Now, you can see that in both low volatility and momentum, the excess return distribution is quite towards the right side. Now, if the distribution is towards the right side, when I say right side, the center line that we are considering is a 0 point. Or if more number of data points are towards in the positive value, it means this strategy or this factor is doing better than Nifty 50 most of the times. Now, if you remember, value had the least overperformance or outperformance percentage at 50%, whereas momentum had around 83 or 86%. And we also see that even low vol is doing good. Low vol also had an overall outperformance percentage of 80%. Yeah, so it was around 80%, and momentum is at around 86%. So individually, by the strategy themselves, have done really well. in both the regimes. Now the difference comes is like when we compared momentum, when we combine momentum and quality, and if you want to compare that with momentum plus low volatility, I have some bias or favorance towards low volatility as a factor. It is because in both the regimes of 2008 to 2016 and 2016 to 2024, low vol is right skewed, and you compare that with quality. Quality, you see that in 2008 to 2016, it was completely right skewed, meaning most of the returns, most of it during this time had excess returns over and above Nifty. But in the 2016 to 2024 period, it was equi placed, even though some right tail is there for quality, but it was not that great as what it did in 2008 to 2016 time period. Now, if you see now the low volatility, you see that there is decent amount of outperformance even in the recent 2016 to 2024 period by low vol. Now, that was the sole reason which made me more in favor towards momentum plus low vol combination than momentum plus quality. Now, let's see the final resultant output. When you combine momentum and low vol, you see the entire distribution shifts towards the right. That can be seen in this outperformance. The combination outperforms the Nifty 50 by 94% at times. Meaning, if let's say if you enter randomly between this period of 16 years and you invest equally between low vol and Momo and wait for 3 years, then there was a 94% probability that you would have beaten Nifty 50. And let's also see the other aspect which I liked between the low vol and momentum combination. Now, in low vol, notice the blue colored distribution, which is 2008 to 2016. When it is right skewed in 2008 to 2016, in low vol, momentum, it is a little bit towards the left side, even though momentum is fairly towards the right, but still, as compared to low vol, it is skewed towards the left. Now, switch to 2016 to 2024. Now, momentum takes a front seat and low vol takes a back seat. Again, even though it takes a back seat, still, it is not completely as bad as quality when it was 50-50. Still, it had a good amount of outperformance even in the 2016 to 2024 period. Low vol and momentum have the yin and yang feature, just like quality and momentum. When one of the factor is not performing, the other factor still overperforms Nifty 50. That's the key to note here. So when low vol is not doing as great as momentum in the year 2016 to 2024, still low vol ended up performing better than Nifty 50. Now, same was the case with momentum during the period 2008 to 2016. Now, because of this continuous outperformance of both the factors over and above Nifty 50, and yet having this alternating feature, that is what has resulted in the quantum of outperformance being better than the individual counterparts. You see that the bottom 25th percentile of the returns excess return distribution is at 2.48, whereas for momentum is at 2.06, and for volatility it is at 0.54. So as you know, we are not only are interested in the count of number of years where the outperformance has happened, but we also want to know the quantum of outperformance. And here we have a higher surety with a higher amount of overperformance that can be achieved in the low vol plus momentum combination. Now, this was about this multi-factor strategy of low vol plus momentum. We have seen how it is better than the individual constituents and how is it better than Nifty 50. Now, in the second part of the video, let's add absolute momentum as a criteria and see how the returns are for the low vol and momentum combination. Now, for simplicity's sake, I'm referring to low vol plus momentum combination as LV underscore MOM from now onwards. Now, what is absolute momentum? I've already done a video on how do you do an absolute momentum and how do you backtest an absolute momentum strategy. To simply recap, absolute momentum is, let's say you are given only one stock or one ETF and you're asked to apply the momentum principles and do investing. Then what do? You simply see whenever the stock or ETF is gaining strength, you go long or invest. And whenever you see that the strength is weakening, then you get out or exit from that stock or ETF. That's the only thing that you do. You decide when to enter and when to exit. And when you exit, either you can sit on cash or you can invest in safe liquid funds. So that is absolute momentum. Now, to measure the strength, there are a couple of ways we can do. One, we can take the help of moving averages. So this is a plot of Nifty 50 on a weekly scale, and we have used 200-day EMA or 50-week EMA. Now, this 50-week EMA can be a signal of when to enter. Whenever the price crosses above the EMA, we enter, and whenever it goes below the EMA, we exit, so that we are only investing when the asset or stock is in momentum, and we are not investing when the stock is in sideways fashion. Again, we go long whenever the signal is arrived. So this is a very simple way of optimizing any strategy to see if we can get any better returns. So this is the absolute momentum. Now let's see the results. Also quickly, apart from EMA or moving averages, we can also use other signals like to see if in the last 1 year, if the stock or ETF which is in our concentration has performed better than the fixed deposit returns or any safe liquid returns. I've taken that number to be 6%. And in this case, what we're going to do is we will go long on the LVMOM strategy as and when we get a signal that the 1 year returns of LVMOM is better than 6%. And whenever we get a signal that the LVMOM has returned less than 6% on a yearly basis, then we go short. I mean, we exit from LVMOM and we invest in the fixed deposit. Now, the time period for evaluation for us will be month, not daily or weekly. We'll take 1 month as the unit of reference, and every monthly, on first of every month, we will do a check to see whether the last 12 months LVMM has performed better than the fixed deposit rate, yes or no. That is the logic. Now we have implemented that logic in the Google sheet, and based on this logic, we'll get a signal. If you see a number 1, it means that we are going long with LVMOM, and if it is 0, it means that we are exiting LVMOM and investing in fixed deposit. Now, what happens when you are going when you're exiting LVMM, we are going and investing in fixed deposit, right? And then you see that you get a very secular improvement in the returns because we have invested in the fixed deposit. Now, if you are again back in LVMM, you see the returns which are purely again taken based on the monthly returns of LVMM strategy. Now, you can play around this Google sheet, and if you want to know more about absolute momentum, that link also I'll be sharing, and you can derive insight from it. Now, this is how the final plot looks like of, first of all, we'll see the Nifty in red color, and the blue colored line is of LVMOM pure. If you do not apply any absolute momentum filter, just by allocating equally between low volatility and momentum. Now, this is the returns that you get in the blue color. The yellow colored one is the absolute momentum. We'll spend a couple of minutes here just to see what is it different and why is it, what is its peculiarity. First thing that you'll notice that, let me actually move it to logarithmic scale so we can see the previous returns also clearly. Yeah. All right. Now we can observe that whenever we get a zeroth signal, or meaning whenever we get a signal to move out from LVMOM, right, then we are going ahead and investing in the liquid funds. Now you see that we have started this from 2008 March onwards, and when we got a signal to exit from LVMOM during the 2000 market crash, then we invested in the fixed deposit. And you see a smooth secular line in the yellow color where it performed better than both Nifty and LVMOM. And once the recovery has started to happen from June 2009 onwards, then they both started to outperform. But until then, LVMOM was doing better. And fast forward again, whenever you see that there is some volatility, we go into cash and we see a smooth secular trend. The same thing happened during the COVID times, or even in the last year during the Ukraine-Russia war. Now, or during the volatility times, you see that we're moving into cash and thereby protecting the downside. Now, by protecting downside, we're also foregoing some part of the upside, and hence the LVMOM is doing better than the absolute strategy. But the absolute momentum strategy applied on top of LVMOM still beats Nifty. So that is one inference. There are two more advantages of absolute momentum. First, we will reduce our max drawdowns, and second, we'll also reduce our volatility. Now, when you reduce your volatility and maximum drawdown, the chance for someone to exit because of a knee-jerk reaction is eliminated or reduced, and hence you stay longer in the strategy. Now, let's move on to the next one, which is dual momentum. Dual momentum, as you're aware of, is a combination with gold and liquid funds. Now, liquid funds, I often interchange with fixed deposit. Basically, what I try to say is you find safe havens for a shorter duration where you can invest and get a fixed return kind of a product. Now, the reason for choosing gold is that it has a complementarity nature or has less correlation with equities in general. And hence, we have used Nifty, gold, and liquid funds in the earlier dual momentum investing video that we did. The video's link will be provided in the description. If someone interested, they can watch that video. I'll also share this Google Sheet so you can also see the calculations. Now, having said that, in my previous video on dual momentum investing, there was one error which creeped in. And I would like to thank Avinash Singh and Selva who have pointed out this error. So this error is also called as look ahead bias. So what happened was you get a signal either to invest in, let's say, gold or liquid funds or LBMM strategies based on a binary 1 and 0 as signals. Now, when you get the signal as 1, it means you're going long in that particular asset. Now, if you get 0, then you're not going long in that asset. Now, when you are calculating the monthly returns, what ideally we should do is we should take the signal as on previous month's closing and take the position in the current month based on the signal that was given. Now, let's see in the month of 30th April 2008, you see that before that, 31 March 2008, at the end of 31 March 2008, we got a signal to go long in LBMOM. So we went ahead and invested in LBMOM. Now, when you invest in LBMOM, the returns that you're going to get at the end of 30th April 2008 will be 11.69%. And that's the calculation. That's how it should be done. So you get the previous signal and multiply the returns for the next month. Now, the mistake that happened was this value got interchanged to this value. So you're taking the month signal, end of the month signal, and calculating the returns from the start till the end. So even before getting the signal, you're actually investing in that particular strategy. So that was the calculation mistake that had happened. And when you drag it, obviously the values get changed. Now that has been corrected. You can see the earlier Google sheet of dual momentum between gold and Nifty. Now following this, let's see what are the results that we get in LVMOM and gold and liquid funds. Now this is the result of dual momentum strategy. The LVMOM is in red color, and in golden color you see the gold, and the blue one is the dual momentum. Now you might notice that dual momentum performed well, even better than both gold and LVMOM for quite a considerable period of time. And the LVMOM crossed over the dual momentum recently in 2023 November onwards. Now there might be a reason for this because it has a starting point bias. The starting point for this analysis is from 2008 March 31st onwards. Actually, we should say it is good for us because that is when, if you notice the chart of the Nifty, that's when the start of 2008 crisis started to happen. So if let's say we were to invest at the exact tops of any bull run and we follow the dual momentum strategy, what would the results would look like? Now, if you start from the bottom of any crash, definitely they might look better. But we want to see the exact opposite of what happens when you start at the top of any bull market and follow strategy. How would it pan out in future? So that's how you can see these results are. You start at the exact top of 2008 bull market, and then the LVMOM crashes, the red color line that you see, it falls from a NAV of 100 to almost still levels of 70, 60. Whereas the gold is stable and it pushes along, it moves forward. Since in dual momentum, we stick to only one asset, which is doing really well in the last 1 year period. So we have gone long with gold and we have tagged along with gold till this point of time. And from 2013 onwards, gold started to go sideways. Now, since gold started to go sideways, we have now switched to LVMOM because the logic said, or the signal that we got was to move to LVMOM, and then we've piggybacked LVMOM till this point of time where the COVID crash happened, and during the COVID crash again we moved to gold, and that's how the dual momentum pushed even further, and it continued to move forward. Now you see that there is a strong negative correlation between gold and equities, and equities you've also seen that when we did Nifty and gold plot, it is also visible in this chart. Also, you see the gold and red, which is LVMOM. LVMOM is nothing but these are also equities, but we are taking those equities which exhibit momentum and low vol as factors. Now, when equities underperform, gold does well, and gold goes sideways or doesn't underperform, then equities do well. Because of this alternating feature, we are able to make best of the both worlds and move in a upwardly fashion. Now, to eliminate the starting point bias, let's also take a look at the rolling returns. We'll take 1 year rolling return, 3 year rolling return, and also 5 year rolling return to see how the results of dual momentum strategy are. Now, this is about dual momentum. What we'll do is we'll do a comparison, a thorough comparison between absolute, dual momentum, LVMOM, Nifty, and gold. So this is the final analysis table. We'll compare all the 5 different strategies on different parameters. So let's take a look at what our parameters are we comparing. We'll first see the absolute returns or the point-to-point returns. As I mentioned, it has a bias, so we'll be not giving much weightage to these returns. But as you can see in the absolute terms, LVMOM does phenomenally well, and dual momentum comes a close second. You can compare Nifty and gold. These are way less than any of the combinations of LVMOM, either absolute, dual. And the next is we do a calculation of CAGR. This CAGR again is a point-to-point calculation, but annualized to 1 year. So it's just in an annual fashion. So again, you see that on an average, Nifty gave 12% annualized returns over the last 16 years, whereas LVMM gave around 18%. Now, the important metric that we'll consider is the maximum drawdown. During the course of the 16 periods from 2008 March onwards till 2024 August, in the 16-year period, what is the maximum to the level in which this strategy has fallen to is captured by maximum drawdown. Now you see that the strategies which have higher maximum drawdown, I mean a bigger maximum drawdown, let's say 46 or 45, they are colored in red, whereas the ones which are having less, like 17 or 22, are colored in green. So we prefer the ones which are having lesser drawdown. When I say we, it is again personal choice. So you can consider maximum drawdown as something like a heart attack for any human. You might get at some point of time in your life, but it doesn't mean that you get it very frequently. At some point, you might get, and there are people who want to optimize or protect themselves from getting heart attack. So they do take exercise regularly, eat good food, etc. So by taking the extra pain of being fit and healthy, they're trying to avoid the heart attack. Now, same way, there are people who are excessively focused on drawdowns. They can't bear seeing the profile fall by 45% or 46%. They want to tone this down. Now, to do this, you can apply the absolute momentum strategy or dual momentum strategy. Now, when you apply this, you see that the returns also get eaten away. Now, if you're following purely LBMOM, you get around 18% annualized returns. Whereas if you're taking absolute momentum or dual momentum strategy, you end up taking 1 to 2% per annum. When you compound it for 16 years, it will be a very big value. But you are taking that extra pain of taking less returns for more comfort of seeing less drawdowns. So not everyone will see from the same lens of returns. Some people see from this lens also. So for people who are completely risk aware, maybe this style might, or focusing on this metric might be important. Again, when I say risk aware, they are risk aware, especially to see a maximum drawdown minimized. Now, when you do a Roman ratio, which is nothing but the returns divided by the maximum drawdown, you see that the best value is in dual momentum strategy. And even in the max drawdown point of view also, dual momentum scores the best because it has the lowest drawdown of only 17% in the last 18 years. And that's because you are switching between gold and equities. And when you see the rolling returns, again, we'll not see the 1 year rolling returns. We'll see 3 year rolling returns. If some of the long-term investors might also see 5 rolling returns. On 3 year and 5 rolling return basis, we see that the LVMOM, the pure strategy of blending low volatility and momentum, yields the best returns. If you're someone who's not concerned about the max drawdown and you're focusing only on returns in the longer term, then this alone will be a great metric to look at. When we say returns alone in longer term, for us, longer term is 3 years. For some people, 3 years is short term, and 5 years is maybe medium term. For maybe in this generation, I think 3 years itself is looks like long term. So let's take 3 years as a case for evaluating any strategy's performance. And you obviously can see that the longer tenure that you have, 5 years or 7 years, then the surety of getting returns is even higher. But for starter's sake, let's take 3 years. And in this case, LBMM is good. Now, the third metric that we want to see is the percentage outperformance. You might have seen this comparison this analysis that we have done in the previous videos of other factor indices, where we want to see the excess returns and see what percentage of the duration are we getting excess returns over and above Nifty 50. Now, if you take that angle again, LVMOM scores really well. You see that you get positive returns, or not positive, excess returns over and above Nifty 50 97% of the times if you are invested in LVMOM. Now, that again gets dwindled when you are in either absolute or dual momentum. Now, in absolute or dual momentum, the downside is protected, but the upside is not. And when the upside is not, there can be instances where you might underperform even Nifty also. So that is the point that one needs to take care. So if you're only focused on the surety of getting great returns in the long term, if that is a metric, then again, LVMOM pure sounds good. Now, if you are interested in seeing the bottom 25th percentile of the excess returns, and we are interested in that number, then in that case also, the LVMOM strategy sounds or is better handsomely than any of the other strategies. In other strategies like absolute or dual momentum, you in fact even might get lesser returns than Nifty 50 or longer period of time if you follow that strategy. Whereas if you're purely following on LVMOM, you might end up getting a decently good enough returns over and above Nifty 50. So this bottom 25 percentile and this percentage of outperformance, these two are calculated based on rolling return basis. So the last metric that if someone wants to focus is volatility. Now there are people who want to see their NAVs or their portfolios move in a very smooth fashion. They don't want lots of jerks in between. I'm not talking about one sudden event like a crash of 2008 or 2020, but in general, throughout their entire journey, they want to see the portfolio to be moving in a smooth fashion. And people who prefer those kind of portfolios might take a look at volatility as a metric and see which one of it is doing better. If you're considering only volatility as your metric, then the absolute momentum might be more suitable because that gives the least standard deviations in the entire journey. So someone who's looking at less fluctuations on in daily life, then this is better. So as you see, there are different types of investors, and each type of investor has focus on one particular metric, and based on a metric, we have shown which one is performing better. But on uh, both of the counts, I find both either LVMOM or dual momentum to be good enough. Absolute momentum or trend overlaying strategy eats up quite a bit of returns, and we lag in terms of getting into the strategy and getting out of the strategy. So I prefer either LVMOM pure or dual momentum. Now that is the overall analysis. Let's also take a look at the charts once and see how are they looking like. You can see the 6 different assets so far that we have discussed are all plotted together so that it makes easier for someone to do a comparison. We'll start from the fixed deposit, which is in the magenta color. You see it is a straight line, slanting lines moving upward with low fluctuations. Ideally, we want something similar like this, which moves in a straight fashion, but not with this slope, maybe at a higher slope. That's the wish of all the quant investors, to get a higher upward sloping curve. Now, that's the reason we find all these optimization or better techniques to smoothen the curve as well as increase the slope. Let's see if we have been able to achieve that. Now, the base case is by investing in NIFTY, which is in blue color. That's the by default option. Most people are comfortable investing in the indices. Now, that's represented in the blue color. Now, we also have gold, which is measured or which is represented in the golden color. And obviously, you see that the gold has a yin and yang or complementarity feature with respect to equities. The blue color line is when it goes down, the yellow colored line moves up, or the golden color line moves up, and when the gold color line goes down, the blue color line moves up. So that's the whole point of having gold as one of the asset in our arsenal. The third thing, or the third asset that we have seen is the LVMOM. Now we have, first of all, covered what all factors are available. And within those factors, we have seen certain combinations, and we have picked one such combination which yielded the best returns and also ensured that we get higher returns over and above Nifty 50 for a considerable amount of time. That's how we have zeroed down on LVMOM. Now the LVMOM is in the black color line. You see this LVMOM, yes, it has its own fair share of volatilities, ups and downs. And that is the reason it is not as smooth as this one, but yeah, it has its bumps, but still on the longer term, it yields the best returns. Now, on top of it, you have seen that we have overlaid absolute momentum as a criteria. Now, the absolute momentum is in green color. And you have seen the results also that absolute momentum has the least volatility because we switch between LVMOM and liquid funds in between whenever the trend is out of fashion. So you see that this smooth lines is what gives the reduced volatility, and also we're able to get a decent upside. Now let's take a look at the final one, which is in the pink color one. So this is what I was referring to, like when I say that we want to improve the slope of our investing and also ensure that the fluctuations in that line are less. So that's the final aim. And with the dual momentum strategy overlaid on low vol plus momentum, we have been somewhat close to achieving that objective, where you can see that the returns of the pink colored line, which is in dual momentum, is better than all the other strategies that are there here. And also we see that it has a reduced volatility even when compared with respect to Nifty or even the LVMOM strategy. So that's the whole essence of doing a dual momentum on top of low volatility plus momentum multi-factor. So you can also do a similar way of combining different multi-factors and then seeing what is the final resultant. And you can do a dual momentum or absolute momentum on top of it. There are also a lot of variations. Maybe I've taken only 50% weightage to momentum and 50% weightage to low volatility, and I have combined these two factors. You can take different variations. Maybe you can combine 80% to momentum and 20% to low vol, or instead of low volume, you want to take quality, etc. So you can do different combinations and see how these strategies are optimized and how you can get the best results. All right. Thanks, guys. Have a nice day. I hope this analysis was helpful.